I'd like to thank Dr. Greenspan for joining us today. I see the clock is already ticking down from 20 minutes, so let's just jump in and talk about our frustrating economy, which seems to be gaining at least a little bit of leverage right now. We've seen some decent data on job creation, small business confidence, but every time we step forward, we seem to step back again. Can you tell us if we are at another false dawn in the economy? If not, what are your prospects for growth going forward the rest of this year? And how does the current outlook for both the near-term deficit and long-term debt impact our prospects for economic growth?
That'll lead up.
Oh, here's your mic.
That'll lead up 19 and a half seconds.
Exactly, but I'll ferociously interrupt you, so.
Let me just say this, that there's no doubt that there's been some pickup in the sense you see it in a number of places. Strangely enough, the most critical one is the one you mentioned about the small business confidence. That's a fairly good indication of what's going on more generally than you realize. But the one that I find most intriguing to me is after a remarkably unmoving period of stability, commercial and industrial loans tilted up. Now, the reason that's important is that it's essentially, I've always viewed it, and I think correctly, as the canary in the coal mine. It's not the biggest part of the financial market, but in a way it's the most sensitive, and it's trying to tell us effectively that all of the QEs, QE 1, 2, and 3, are starting, perhaps just starting to move. Because to this date, with the exception of the extraordinary rise in asset prices, which the QEs have done by bringing real long-term interest rates down, it's very hard to see any impact from that. And the reason is that it's essentially commercial banks with deposits at the Federal Reserve Bank in New York or San Francisco or whatever, just sitting there getting 25 basis points return, but no reason to move it. This is the first sign that I've seen that it may be moving. But to the bottom line of your question, this may also be a false dawn like all others because there is some structurally difficult problems that are emerging in this country, which is going to make it difficult to really surge forward.
Okay, well, let's talk about some of those structural problems. And in the context of this discussion, obviously the long-term debt is foremost on our minds. We have smaller short-term annual deficits now. The trajectory of long-term debt stays as it is, and the return to trillion-dollar deficits is not far off the horizon. What impact is that having now, and will it have if more steps are not taken to address that long-term structural problem?
Yeah, well, I think it's the problem, or more exactly, it's the symptom of a big problem. But one of the issues that I have very much which bothers me about the discussion of the debt is that, to be sure, as of yesterday, we had, I think, $12.5 trillion unified deficit, and we have $1.5 trillion of a combination of Fannie Mae and the Federal Home Loan Banks, which are government, essentially government agencies, no matter what we call them. But we're missing a very large number, and that's what I would call contingent liabilities. Let me just give you a case in point. Before I went into the Federal Reserve in 1987, I spent 10 years at J.P. Morgan when the big issue was their AAA rating. And you can imagine the differences it is now. But we had a lot of what we would now call London whales, where this is this big major loss that appears on the books of J.P. Morgan. And it was essentially an issue between the directors and the management. It never got outside of that twosome. Today, you get that sort of thing, and Jamie Dimon gets called up to the Senate. And the reason basically is implicit in this whole arrangement is J.P. Morgan is a Fannie Mae, Freddie Mac type of institution because they are indeed too big to fail, and taxpayer monies will come in behind them to hold them up if necessary. This means that because debt is critical not when it just exists, but when it has to be repaid. The problem is that the federal government is viewing at the debt issue as, I don't know what totals they're thinking of implicitly, but they're a very significant part of the financial institutions. And since we're also bailing out Chrysler and GM and AIG, it's got to be a lot of the non-banking as well.
So what I hear you saying, I think you're saying, is that you have a federal debt of $12 trillion, whatever it is, plus 12.5 trillion, plus an essentially unknowable number that stems from the continued existence of both too big to fail banks and perhaps other institutions. So could you put a number on what the current federal debt actually is?
Well, you basically have to, first of all, we do have a long list of systemical financial institutions which are too big to fail. They're not supposed to be that, but that's what they are. I'd start there because I can't conceive of some regulator looking at and seeing a SIFI and saying, well, it is possible they may make it, but if they don't, I will be pilloried for not acting. The safest thing politically to do is always to bail out somebody rather than not bail out. This is fundamentally different from the way it was many years ago. I was on the, basically, Resolution Trust Corporation board back in 1989, which we had, as you know, a huge block of savings and loans coming to the group to get rid of. Well, we got rid of all of the mortgage assets and liquid assets quickly, and then we were caught with 8-hole golf courses, buildings which were supposed to be 25 stories high, and they built 15. Those were utterly illiquid, unsaleable, and we all decided that the best thing to do is to package the whole business and put it up for bid. We knew we'd get 50 cents on the dollar, if that. And we knew we would get terrific congressional criticism. But that's the act which took place. There were no bids in there at the very beginning, and the market was dead. So we let the market start working on the bid, and Wall Street all of a sudden looked at us. The vulture funds were looking and saying, let's get in there. These guys are starting to make money. Within several months, that whole thing was cleaned out, and I'll bet you that that action saved the taxpayer $100 billion.
Yeah. I want to talk about asset bubbles for a minute. We had an interesting conversation about this on the phone the other day, and you made some points that I hadn't heard you make before. And I want to talk about it in the context of what Mel Watt said yesterday, the government now moving to make mortgages more widely affordable, some concern that that could lead to a reinflation of a housing bubble. What is your view on whether bubbles are good or bad? Do we need bubbles to get faster economic growth? And can you have benign bubbles versus toxic bubbles?
Yeah, I think that's the good way to put it. Let me just say this. A necessary and sufficient condition for bubbles is to have a protracted period of long, stable, non-inflationary growth. If you get that, a bubble will emerge almost certainly. But bubbles have emerged and nothing has happened. For example, the dot-com boom was a huge bubble, and like all bubbles, by definition, burst. It had very little impact on the economy as a whole. To be sure, the people who essentially had the equity positions in the high-tech stocks at the time lost a huge amount of money. But that was essentially an unlevered financial group of people, And so there was no serial contagion of defaults. And that meant that a lot of people lost money, but it had no systematic effect. We had the same thing in October the 19th, 1987, when we had this 22% decline in one day, the greatest decline in the Dow before and since. Nothing happened thereafter for the same reason, namely that the holders of the toxic assets were basically unlevered. Pension funds, 401ks, for example, mutual funds, and back at that time, households, which didn't have very much debt. When we got into the housing boom, it turns out that what we were dealing with was, yes, there was an extremely large amount of leverage. And so when the equity part of it collapsed, it brought down the house because you had basically contagious defaults. We had that also in 1929, when back then the comparable debt was the call money market. And the whole thing blew apart because it was a highly levered system. But it matters fully whether the toxic asset is held by a levered or an unlevered group of institutions or people.
We have a number of audience questions coming in. I want to ask one that I'm sure is on a lot of people's minds. We've got unemployment now falling towards 6%. Is there any reason now to be concerned about inflation, even though we do not see signals of it for the most part in the incoming data?
Well, you could have said that yesterday. Yeah. The Producers Price Index this morning
True.
Moved up significantly. The core part of it moved up. It came in as a big surprise. Now, I don't know whether or not that is other than a blip, but if inflation is beginning to pick up, it's got to start somewhere, and it usually starts the way we're looking at it. Now, I'm not forecasting inflation is about to run. I doubt it very much, but the presumption that it's no longer on the horizon, I think, is a mistake.
And do you think that we will eventually, or in the near term, see more significant wage inflation? Obviously, we haven't seen a lot of it, to a lot of people's dismay. What is your view, basically, on the amount of slack that's in the labor market now and the likelihood that this wage increases that we've been hoping for will materialize in the relatively near term?
Well, I think you have to ask yourself, why is it so dull? Why is that market so dull? Because I remember, okay, you go back to the 1950s, and you had extraordinarily strong labor unions and very strong labor markets, and wages were terrific, and I should say they were terrific, and inflationary pressures coming from them. But back then, 37 or some odd % of the private labor force was unionized, mainly UAW, USW, and now it's down to well under 10%. There's no power in collective bargaining anymore. And aside from that, we're getting an extremely sluggish, structurally dampened economy for reasons I go into in the book that was published back in October, and paperback will be coming out shortly. But what I go into is the reasons for, that was a plug, of course.
Find the book on Amazon.com.
I didn't want to let that go by unacknowledged. But what we're looking at is basically the economy is moving very sluggishly. The demand for labor is quite soft. And the problem isn't, the problem, as you pointed out, it's not the unemployment, or it's not even the structure of who's working, who's not working. It's the fact that there's an extraordinarily large amount of marginally low-income workers, which are a function essentially of the slowness in economic growth. If we got growth up to 4%, that problem would disappear overnight.
Yeah. Well, hopefully we can get to that, as some people are calling for. I want to refocus a little bit on the theme of this summit, which is the deficit and the long-term debt. And we talked a bit about your views on how much that is crowding out other investment. Talk to me a little bit about your views on that issue and how much worse it will get over time, given the long-term trajectory for the debt.
Yeah. Well, I think also in this book is a set of data which essentially demonstrates that when you have a significant or any deficit, it crowds out essentially private fixed investment. That's what the data show, and I go on to describe internally why arithmetically that is what happens, and the correlations are very high. I mean, you can't get around them. You can't get around the facts. That's what it is. The basic issue is that we're just not saving enough. And one of the very extraordinary statistics, which I still don't fully understand why it exists, but it does, is that the sum of gross domestic savings plus entitlements has been relatively stable for 50 years, which taken as it is means that every time you increase entitlements, which remember are not market-based, these are not appropriated funds, these are basically the 800-pound gorilla in the financial market, which crowds out everything else. Well, indeed, it does crowd out domestic private savings, but domestic private savings plus the savings, if any, that we can borrow from abroad has to equal gross domestic investment. And gross domestic investment, because it affects, there's a critical input into the gross capital stock of the society, which fundamentally drives productivity and therefore standards of living. And that, to me, is where the real problem of economic policy is. So long as that phenomenon continues, we're going to get a sluggish economy. We're not going to get the revenues on the tax side, which will fund these entitlements. The thing that I might add, I also point out, is we started out by funding them, and then we said, forget it. And one thing when you eliminate revenues is that the deficit goes up.
The clock is mercilessly ticking down. I want to ask you quickly about a bit in Tim Geithner's book where he talks about his regrets leading up to the financial crisis, that at the New York Fed he didn't pay enough attention to the amount of leverage building up in the financial system, as you talked about exacerbating the housing bubble when it burst. Are there things in your tenure at the Fed that, in retrospect, you look back and say, I should have seen this coming, I should have seen that this bubble was going to burst with such a cataclysmic impact on the global economy, or not?
Well, how about how many of the bubbles I forecast which didn't happen?
Okay. Well, you can lament those too, if you like.
You know, the forecasting business is a very unthankful activity. And everybody's in it. The Federal Reserve governors, regulators, because remember that a very substantial part of regulation implies a forecast of the type of company or the future. It is very rare, a very small part of regulation is independent of what the regulator's view of the outlook is. I mean, for example, a credit rating agency, they're viewing the future of the company. And AA, AAA, single A, whatever, that's all a forecast about the future. Sometimes it's right, sometimes it's wrong.
Quickly, as the clock ticks down, I wanted to ask you about your experience reforming Social Security. You've got some experience in that regard. How could that inform the next set of discussions we hopefully have in 2015 about long-term entitlement reform? Given your experience, how would you guide policymakers as they hopefully attempt to address this the next Congress?
Well, it's very obvious that if you look at the Social Security system, the best thing I would suggest to everybody is to take a look at the annual report of Social Security, old age and survivors insurance, and the disability structure, and just look at it, and then look at the forecasts and the like, and then read it. Because what you're going to find is towards the back are the actuaries of the Social Security system giving their discussions as to what they think is going on. They say, and they have for years, that it is grossly underfunded, that in order to fund it correctly, you're going to have to either raise taxes significantly, Social Security taxes, or you're going to have to lower benefits significantly. This is, not 5, 10%, so we're talking 20, 30%. But politically, that's almost impossible to do. But I want to understand why it is that the secretaries, the cabinet secretaries who signed that report, whether they've really read it, because the second part contradicts the first.
Well, Dr. Greenspan, we're running out of time here. I'd like to thank you for joining us. You should go buy Dr. Greenspan's book on Amazon.com, and you should sign up for Politico Morning Money at politico.com/morningmoney. So that'll end our plugs and our interview, and thank you very much for your time.